Right.
No warm up, ladies and gentlemen. I just walked right into the StreamYard here, and we got JC right here. He's an options connoisseur, as he's titled himself. First time that he appeared on one of our live streams. He and I have been having conversations via DM about options trading strategies, and he's a very, very sharp guy when it comes to options. Very experienced. Thanks for coming on the show today, Jay.
Yeah, no problem. I appreciate you having me. Was talking with you last time and mentioned to Ray that it's 2 a.m. over here. I am in Sydney, but it's very normal for me because this is when the options market is open in the U.S. So I usually trade most nights for an hour or so, and then head to bed, and then maybe wake up, adjust some things before close, and if not, then just wait for the next midnight hour the next day. So yeah, but happy to be here.
Hell yeah. Thank you for joining. And so, when we think about options, and Ray, maybe if you pull up Robinhood while we talk, that'd probably be good so we can see some live premiums, because the options market is live right now in the United States. Of course, between 9:30 a.m. and 4 p.m. Eastern time is when you can actually trade options. I've actually put in a couple trades today, Jay. So let's say, somebody's a beginner. Somebody's brand new to trading options. They don't have a big bankroll. Let's say their bankroll is $5,000 or less. Some might have $1,000 bankrolls.
Yep.
What sort of strategy would you implement to start to get the ball rolling for somebody like that?
Yeah, I mean, the interesting thing about options is that actually having a small bankroll isn't as detrimental or as difficult as if you're just trying to make money by straight up buying stocks, right? Because they're so leveraged, $1,000 and even like $5,000 can go a lot further than it can with just buying shares. So realistically, the strategies I would probably pick are things that are similar to what people are already used to in just buying stock. So similar to what we talked about before about selling puts, right? If you've got a stock, you're like, oh, I would buy this stock here at this price. Let's say it's Apple. I think Apple's at 130 or something right now, right? If you're like, oh, I'd buy Apple at 130, and you go, well, would you buy it at 125? Well, yeah, of course. I said I'd buy it at 130. Why wouldn't I buy it at 125? So they can sit there and they can sell a put option at 125, and then they've got that same exposure to Apple with a lot less capital deployed, right? Now, obviously, if you sell that put, you've only got limited upside because you can only make whatever credit you've received. And you do technically have the unlimited risk. But the worst case scenario here, Apple goes down to, let's say, 124. You end up owning Apple at 125, which from the very beginning we said you were happy to buy it at 130, certainly happy to buy it at 125. Now you're just in the position at 125. And in the meantime, you also got some options credit with it.
The only thing on this, and obviously what you're saying is correct, but in order to sell a put on Apple, you're going to need 20K of capital, 22K of capital accessible to you.
Correct. If you are selling that put naked. So I was hoping you'd pick up on that. So, right, we sell. Okay, so let's use a more realistic strategy. So here, if you sold this 215, you're right. You would need $21,500 because it's worth 100 shares. But if you then bought just below it, so scroll down. I'm not as familiar with Robinhood, but
click buy on the top left. So we're going to buy, and I'm assuming we're buying a call, right, Jay? Or are we buying a put?
So we're gonna sell a put, and then we're gonna buy a put.
So let's go to buy a put. Okay, so here now we're under buying a put with the 3-day expiration. So this Friday, close of business.
Yeah. So you got to do it. It's all one trade, right? So you're gonna sell the 215, and then you're gonna say, let's buy the 205.
So you'd use the builder for that, and so
I think we can use that, and it's a vertical spread. Yep, and it would be a put credit spread, and you can see that it's bullish, right? Because this is the same concept we said before. If you were buying a stock, you would want it to go up. if you're selling a put credit spread, you want the stock to go up because then your options will expire worthless. The credit that you've pulled in is yours to keep. So yeah, you can click start building the strategy. Yeah, so now.
Go ahead.
Yeah, so it's actually kind of combine them for you. So up at the top, if you change that width from 2.5 to let's say 10.
So that
so now
width, that's the spread between the put you're selling and the put you're buying, correct?
Correct. And so the put that you're selling is where you would actually inherit the stock. The put that you're buying is where you could actually flog the stock back off if it went below that. Now, correct. If you want to implement a covered or cash secured strategy where you can actually take on the stock, sell covered calls against it later, etc., this is not the strategy for you, right? Because you don't have the full capital to sell these puts against it.
Right. But this strategy right here is for someone that doesn't have the bankroll but still wants to participate and not do it in the kind of most risk, like the riskiest way, which would be what? Buying a naked call or buying a naked put?
Yeah. And so the key to options to remember is that, like, I think it's somewhere in the 80 to 90% of all options expire worthless. Could even be higher than that, right?
Yep.
So when you buy calls or puts, time works against you. Most likely, percentage-wise, you're going to lose money.
Yep.
However, your upside is unlimited and your risk is limited to what you've used in capital to purchase.
Yep. So in other words, to explain that, let's say I buy a call option on MicroStrategy. I'm a crazy MicroStrategy bull, and I buy the call option last fall in like September at like $200, and I think that it's going to rip to 450 in the next 2 months, which I'm assuming the market thought it wasn't going to do because that's an insane rip. It had been trading sideways for a while, right? So I pay the premium buying that call option. Let's say the premium on that was, I don't know, $2,000 or something like that. That's my risk. I can lose that whole $2,000 because that option can just expire if it doesn't get to the level. If the price of MicroStrategy does not get to the strike price, the level that I'm predicting it's going to get to, and then some, at 450, let's say, I'm screwed, and that option expires worthless, and I just lose that $2,000. I just lit $2,000 on fire. However, if I'm lucky, and I timed it right, and MicroStrategy rips to 540, I get crazy upside as a result of being right on that, because it happened in the time window that I said. But it's pretty hard to do that. Like you said, 90% of the time it's going to expire worthless. So it is the house always wins to some capacity, right?
Correct. That's kind of the concept here. Is buying options is more along those kind of raffle ticket, lottery, casino odds. When you win big. But do you win very often? No. Now, the other side of that is if someone's buying options, someone's selling them. So same concept. You can be the casino. Now, when you think about a casino, they don't ever hit a number on roulette, right? One number hits, or most of the time no number hits, and they just keep raking in everyone's small losing bets, small losing bets, small losing bets. And then eventually they have to pay out when someone hits. So you could be the casino and sell options and slowly take in that $2,000 that you put up to buy. I could take that $2,000 and just hope that 90% of the time it's going to expire worthless, and I keep your $2,000.
Yep. Makes sense.
Yep.
So let's go back to this option we were building right now for someone with a smaller bankroll, because again, buying a naked call or buying a naked put is high risk, 90% chance of not making it. It takes some kind of sophistication. I would say I've never done it. I've literally never done it because I know the odds are very much so stacked against me. So it takes some degree of sophistication to pull it off. But I've sold options like every week. Right now, I have 4 open sells, two puts and 2 calls, a put on Hood, a Robinhood, a put on Tesla, sold a call on Coinbase and one call on MicroStrategy. Normally, I would sell more calls on MicroStrategy because MicroStrategy has insane premium, and I have 400 shares in this particular account. But MicroStrategy's next earnings is going to be at the beginning of April, or sorry, the beginning of May, end of April. So this expires right at the end of April, April 25th, because everyone's expecting MicroStrategy to melt faces next earnings because they're implementing FASB accounting practices, which is going to allow them to count their Bitcoin gains as profits, which they've never been able to do. And this is a new accounting standard that's been you've been able to do for the past like 6 months, basically since Trump got in. And as a result, everyone's expecting MicroStrategy to melt faces with their earnings report because they just have this assload of Bitcoin that they're obviously like up pretty big on. So it's going to be a lot of profits for MicroStrategy. So I have the call expiring on the 25th. So anyway, that's a little breakdown, a part of my current option setup. But to do my current option setup, you either need to have 100 shares of a stock, which for a Coinbase, that's going to be 20 grand. For Tesla, it's going to be 24 grand. For Robinhood, it's only going to be $4,800. So that's an affordable one, relatively speaking. For MicroStrategy, it's going to be 20 something grand, right? So not everybody's got that. And if you're selling the puts, you have to have the cash to back it up. So the same numbers. The only quasi-reasonably priced one is Robinhood. And I want to talk to you about Robinhood. But let's go back to the strategy, because you were talking about Apple, which would be to do it naked. The way we're talking about would be $20-something thousand. But I want to understand this put credit spread approach right here.
Yeah, so let's just choose that 220. Actually, sorry, where are we? We're current price is 213. So we'll just go down the 210. Yeah. So the 210, 200, right? So basically this is saying if Apple on where are we with expiration? Yeah, so just 3 days. So 3 days from now, if Apple is above 210, we would keep that $1.53, which obviously multiplied by the 100 shares, $153 is the credit that we would receive for selling this put spread. And our max risk is 210 minus 200. So $10 multiplied by, again, 100, you're at $1,000. So you're not actually risking the full 1,000 because you're taking in a credit of $1.50. So you're actually risking $8.50 to make $1.50.
So that makes sense. So you're essentially, and what's the, okay. So anyone can do this then, pretty much.
Correct. Yeah. Yeah. And that's probably a quote unquote more aggressive strike price, right? If you went further down to 205 or 200, you bring in even less capital. So the 205, 195, still it's going to be the same $1,000 spread there. 205 minus 195, still the same $10. But here you're only bringing in 60 cents. So $1,000 minus 60, you're now risking $9.40 to make $60.
Well, there you go. So let's bring Ray in. Ray, as a non-options trader, what do you think of this? For like, if somebody didn't have a big bankroll, what do you think of this?
I'm still trying to wrap my head around it. So I'm looking at, like, I guess if Apple goes to zero, I lose everything essentially. That's like the absolute downside. I guess this is the mark right here. So if it closes below 195, I lose 100% of the initial capital, 937. If it stays where it's at, I'm basically like only up a couple bucks. So this feels like a very risky bet right now to take. In my opinion, like, I understand that the upside is unlimited. It's like something crazy could happen. We could have some kind of wild shift at FOMC tomorrow that shakes things up, but it's very high risk.
Ray, the trick here is actually there's not unlimited upside. So you're right. In the picture that they've got there, it probably is to scale, to be honest. But you have to think about the percentages that are not displayed in that picture. So if we could actually see, there's a statistical measure that you can look at. I'm guessing that the 205, the likelihood of that happening is probably in like the 5% range. So you've got a 5% chance that the stock's even going to get to 205, which is where you would start losing money. You've got a 95% chance that it's just going to stay in the green and you're going to make the $60 that you bring in.
Okay, that makes sense. That makes sense to me.
It makes like that's the thing about this picture is right. It shows you very clearly, yes, where here's the profit and loss. What it doesn't include is the probabilities of each of those happening, right? Like similar to like roulette, especially, right? If you don't know how roulette pays out, you would walk up to the table and you go, well, why the hell would I bet on one number when I could bet on black? Well, if you don't know the difference between the two, then that's a very good conclusion. You wouldn't bet on one number rather than black. But once you find out that the number pays out way different because of the different probabilities, then you may reconsider, how do I want to bet?
Yeah, I mean, this feels like an opportunity for the UI UX of Robinhood to be like improved, because this is almost like pushing people away from potentially selecting this because they're making it look like an outsized chance of kind of losing. And like you said, like at first glance, for like an options newbie like me looking at this, it just seems like initially like, hey, this seems like a lot of risk for a little upside.
Yeah, and I'll leave it up to Pio whether he wants me to go down the rabbit hole of why would Robinhood and other options sellers and option market makers be incentivized to have retail users be more likely to buy options rather than sell options?
Well, I mean, I think I can answer it. They're incentivized to have the retail user. Well, so that is actually a question. So why is Robinhood incentivized? I understand why an option seller is incentivized for me to buy an option, but why would Robinhood want their customers to lose money on options, buying options?
I'm not saying necessarily Robinhood, but I mean, Robinhood, I think over the years has proven that it's not completely independent of other.
It's part of the financial system,
liquidity providers, etc. And in general, option sellers, right? In general, like we said before, most options expire worthless. So if you had to choose what you wanted retail spending their money on, right? Like if they're getting the same joy out of buying or selling because they're not fully across how the percentages work and everything else, then you'd be much happier for them to be buying options constantly and then occasionally hitting a jackpot, but in the long run, losing money. As from the sophisticated options market, if that makes sense.
Very interesting. So that's something to think about. So that is a great strategy, what you just showed, for someone that's new to trading options, that doesn't have a big bankroll, that can start to angle to make some money, because you can do this in any market also. That's the other thing, is that it doesn't have to be a bull market or a bear market. Yeah. Beyond that.
And just to finish up on that one too, we chose a $10 spread, right? Which has $1,000 of risk. You saw though, when we first started, it was at a 2.5. You could even do it at a 2.5, right? The premiums will be really small, but then your max risk is $250. And if you're just trying to get a feel for how things work, right? Like that's a really good way to just play around and find out.
Well, now, $250 into a random ass meme coin, like one Solana into a random ass meme coin, exactly. that just came out. And so like this is a more sophisticated, like the thing is you're actually building like skills and awareness when you operate in the options market. I know a lot of people would argue that are operating in the meme coin market, they're building skills, but I'd argue a lot of it is just like, I saw a ticker on Twitter or in a Telegram or Discord chat, and I went and clicked the button, and it's not exactly sophisticated trading. Whereas if you get good at options, you can start small, like we're talking about here, and you can scale out. Ray, you came in. What's going on, Ray?
I'm just saying it's like so much like different. It's just like more intimidating to be clicking the buy button on a $125 option. The $250 downside is to like you said, throw 2 Solana into Melania or whatever the Libra of the day is on the Solana side. It's just a funny juxtaposition.
But it's the same amount of capital. So yep. Like, and you're actually in my opinion, learning something with this. So anyway, Jay, I'll let you continue.
Oh, I mean, but I've got to agree with both of you there because I do the same thing, right? Like I'm trading options. I'll get to one. I'll be like, oh, is this a good option? Let me reevaluate, check it out against my rest of my portfolio, and then I'll go trade meme coins for the exact same amount of money. And I won't even check for bundles. I'll just, yeah, someone in the group chat said hit it, and there it goes, gone. No idea what the percentage is of making any sort of return whatsoever. But I think that also goes with the whole like casino concept, right? If you go into a casino and you got to lay down an actual $100 bill, it's all, your mind almost thinks about it a couple more times than if you just throw a chip out there and you're like, oh, yeah, whatever, it's just a black chip.
Tell me about the wheel strategy and whether you like the wheel strategy of options trading.
Yeah, it's another good one for kind of intro to options, especially if you have the bankroll to purchase 100 shares. So for those that aren't aware, the wheel is where you start off by selling a put, like we just talked about. You don't sell and buy the put, you just sell the put. If the stock ends up below that put, you will get assigned the stock. So just the same as if you had bought it in the open market. Again, let's use Apple. It was at 215. You said, oh, I'll buy Apple at 215. Instead, you sell a put at 210. And at the end of the week, Apple is at 205. So you get assigned the Apple at 210. You collected some sort of premium by doing that. But now you own 100 shares of Apple at 210, and you've collected some options premium. Then what you can do is wheel that back right out, and you can sell a call against those 100 shares. Again, you could sell it right at 210. If Apple now goes back up to 215, your shares will be sold away at 210. So you bought at 210, you sold at 210, you break even. But on the way down and on the way up, you got your options premium.
Yep.
And what we just saw looked like for 1 to 2 days at the money, options premium was what, in the $100 to $200 range. So theoretically, over 2 weeks, you'd make a couple $100 up, or sorry, a couple $100 down, a couple $100 on the way back up. Did I explain that okay?
Yeah, no, absolutely. So essentially, you're selling a put to get into a position, then you are comfortable with either just having the option expire worthless, or you are fine with getting assigned the shares. So it's a stock that you're actually interested in potentially being in. It's not something that you would be upset about holding. And so, for example, with Robinhood, I sold a $38.50 put, 38.5 put, with an expiration of, the expiration is March 28th. So 10 days out, at the money, pretty much 38.50 when the stock's 39.50 right now. And I earned, a couple $100 of premium on that, right? So that's just free money for getting into this position. If the shares get assigned, then I will, so let's see right now, 38.50, Ray. And then the expiration date, instead of 3 days at the top, it should be 10 days out. Okay. So there you go. Scroll down, 38.50. There you go. So right now, if you bought the exact same option that I did, or sold the exact same option that I did, you get $166. Okay. And then if you end up getting the shares assigned and you buy 100 shares at 38.50, that would cost what, $3,850. And then you would turn around and you would sell a call. So Ray, switch it from sell put to sell call. You can do the same day, sure, and scroll down a little bit. And let's say we sold it at 40 because we don't care about the shares being called away. We get $205 of premium, right? So we get 205. I don't know why. Why does it say 374 right there on the right? The estimated credit. Why does it say that?
It probably kept both of the options in there.
Okay, because he's doing a builder. Okay, that makes sense.
Yeah. So I think it built it on, but.
So it tells us the total profit. I'd make $375 of just cash profit from this process. The risk is that the Robinhood shares go way down. And so I can't sell at the money covered calls because then I would take a loss and I'd have to sell the covered calls closer to the price that my cost basis, the price that I got the shares assigned to me at. But you can always roll these options out. But the point is, I'm using Robinhood because I'm trying to build, and I'm using margin too, and we can talk about that a little bit. That introduces layers of risk, but I'm trying to build, maybe call it like a $50,000 options, war chest, where I'm swinging 50K back and forth, probably on like Robinhood and Tesla, not MicroStrategy, because I want to hold MicroStrategy forever. And right now,
oh God, we know.
My feeling is that MicroStrategy is going to absolutely cook. And so as a result, I want to hold it. I don't want to risk selling covered calls on it because of one of those explosive movements to the upside. I just don't want to be caught with my pants down on that. I also want to be able to like live my life to some capacity and not have to constantly watch the price action day over day of MicroStrategy. But for stuff that I don't care about losing, so to speak, like having the shares be sold, Robinhood on a small scale, because the share price is under $40 and thus 100 shares is under $4,000. I like that. $4,000 bankroll. A lot of people have that. That's reasonable. It's reasonable for me. That's fine. And then Tesla is the big boy version, because Tesla's in the 200s for a share price. What is it right now? 240, something like that is how much Tesla costs, I think. And so that's 24K to get in the game with that. So I almost want to graduate to Tesla. I have one live put on Tesla sold, but it's the 10 Delta put that you actually DM me about. So I sold the put at $200 at the time. Tesla's gone down since then, so it's $228 right now. If it gets closer to $200, I'll probably I'll either roll it down, or if I feel like it's a really, if the bottom is sort of in, and the way I'll tell that is essentially sentiment about how bad the stock market's doing and how bad Twitter is. The communication on Twitter is about Tesla. I won't roll it. I'll just get the shares assigned and I'll just turn around and I'll start selling covered calls. Because if you look at the premiums on Tesla, everybody, look at how aggressive these premiums are. So sell a call on Tesla at the money. You're going to get $680. That's expiring on Friday, by the way. Let's roll out that expiration to let's go April 11th. So I'm going to get $1,600 of premium for selling one call on that. Just boom, $1,600 into my Robinhood account. So Jay, what's the downside of having this expiration date be 24 days out versus the one that's expiring in 3 days? If I'm running the wheel strategy to a T, what's the downside of that?
Well, so I definitely wanted to cover a bit of the other. Before we get to this downside, the main downside of the wheel is you got to remember Robinhood, yes, is at 38 right now. Robinhood, I think last year was at 8, right? Yeah. If you are entering this wheel strategy and you get assigned shares at 38, it could take a long time to come back if it goes all the way to 8, or it could never come back. With that being said, if you were already going to buy shares of Robinhood at 38, your risk profile is really no different. But it is important to remember that going into this strategy of, I'm going to sell puts and then I'm going to sell calls and then I'm going to sell puts and then I'm going to sell calls. Like you said, if it drops too much, the selling calls is no longer viable and you're just stuck with the shares until they come back to your buying point.
You have to be bullish on the stock because, or you have to think that the stock's going to at least stay the same. You can't do it with a random ass stock. You can't find some random stock that has good premiums like a Carvana or something, because then you are going to feel like an asshole if you get assigned the shares and they just keep going down. But if you think that Robinhood stock is at fair value here, or it's going to, go up, that's why a lot of people do this with MicroStrategy. Everybody thinks MicroStrategy is going to go up for the most part. That's selling covered calls on it. But they just want to generate some kind of, income. And the reason they're able to generate that income is because the volatility on MicroStrategy is so high that it's kind of an option seller's dream. And so even, strike prices that are 2x the current share price of MicroStrategy can earn some premium.
Yeah. Yeah. And to cover what you were saying too, what's the additional risk, right? I mean, the additional risk is the additional time, right? So if the option expires on this Friday, obviously you only have to worry about a rip between now and Friday. If you go 3 or 4 weeks out, you got to worry about a rip for the next 3 or 4 weeks. And as we see a lot with crypto and especially with MicroStrategy being mostly following Bitcoin, I think the majority of the gains for Bitcoin are all in a couple of days every year, right? It rips your face off and then it kind of chills or comes back down a bit. But, so if you think about it, I mean, it depends how you look at the probabilities though. Like you could still get a rip between now and Friday. You could get no rip between now and 3 weeks from now. So yeah, like it's all part of your analysis and how you feel like things are going to go and what the current sentiment is. Same, and like you said, are there events that are going to affect it? Are there earnings? Is there a CEO? I mean, not in MicroStrategy's case, but in a lot of cases, maybe a CEO is planning retirement, or there's other big news. They've got a big product coming out or not coming out, or the bio companies, they've got drug results being released. All of these things you have to consider because those can make drastic swings in the price, and that will drastically change, obviously, the options.
Absolutely. I want to bring Ray in. Ray, now that we've covered some pretty fundamental concepts here, and Ray, have you ever traded an option in your life?
I feel like I've just like randomly traded some options like way back when I first like started with Robinhood, just to like get like a handle on it and do some gambling. But I haven't touched them in years.
Okay. Oh fuck. All right. So you guys just fill the air for 1 second.
Yeah.
Was it or was it GameStop?
I don't think it was GameStop. I honestly think it was something. I think it was something pretty much random. I'm gonna bring my screen back up though, and look at some more of these options.
Yeah. Sorry, go ahead.
I'm back real quick. Ray, the reason I brought you in, and I want to look at these options, but now that we've shown this, for example, this stuff with Tesla, this stuff with Robinhood, obviously you've heard me talk about MicroStrategy. As someone that's not doing this, and I want you to be completely honest here, seeing the wheel strategy and seeing the other stuff that Jay's bringing up, does it make you interested in trying to deploy one of these strategies for passive income or just to generate yield on cash at all? Is it interesting to you at all? Or are you like, I don't think that's for me?
No. I'd be interested in it if I wasn't in crypto, but I just do so much with crypto that I think it's EV negative for me to spend time trying to learn this strategy, if that makes sense. So for me, I'm somebody who like, I have passive yield strategies in crypto. I'm actively trading in crypto. It would be trying to learn a new investing category when I think it's more EV to be like in my lane right now. Would it have been, if you asked me this question in the summer, it probably would have been more EV for me to kind of start learning options when things were cooler and there was less volatility in the crypto market. There were less opportunities per se on a normal basis. But right now, I just think it's EV negative for me to be pursuing the level of knowledge needed to get into options and then the amount of time to potentially babysit them depending on market conditions.
Fair.
Okay, quick follow-up though. Do you have I explained the like covered call concept well enough between PO and I? Like,
yeah, I think at like a layman's level, I understand it as basically being the house in these scenarios and winning enough over time with the small. It's basically the inverse of like the lottery player. You have the high percentage of winning small amounts over time with a low percentage of just getting absolutely wrecked here and there, depending on your risk tolerance and how wide your spreads are on some of these.
Yeah. And so with the covered call strategy, the reason I bring it up, and PO, you may or may not know about this, but there are actually options on crypto now. And within that, there are also now vaults that will deploy covered call strategies for you on your, I think it's mostly just Bitcoin and Ethereum at this point, where you put in your Ethereum and then they deploy a 20 delta call strategy every week. And it has a APR of what's happened over the past 4 weeks. And you basically are giving up, again, your upside because you've deposited your ETH. If it rips through the call then your ETH's going to be sold off at that call price. But is that something that like you would be interested in, or you think other people would be more interested in, where it's like less of a hands-on approach, just more of a you're trading a lot of upside for more like an APR?
Yeah, I mean, it would depend on what that APR is. I'm basically getting like 14% on uninvested USDC right now. So it would have to be, what's up?
Via Blast?
Yeah, just pure USDC. It's not like token or anything. So 14% pure USDC, 14% APR on that right now, which is auto compounds. I don't know, every 5-10 minutes or something like that. So that's like my like stable yield. So if it can like outperform that without a significant amount of risk and without a significant amount of hands-on, like I would consider that. But that's like basically my safest amount of like chunk of money is sitting in that sort of strategy in crypto.
Got it. Cool.
All right, so maybe to close out here, what stocks, or well, hold on the crypto options trading, can I sell covered calls on like Solana?
Can't imagine. Solana in there? No. Solana, the platform that I've used is called Derive, and they only have BTC and ETH.
Okay. All right. Fair. So go ahead.
I was just going to say, and to be specific about like, this is a bit probably technical, but it doesn't work the same way as actual stocks and covered calls, in the sense that they will not actually call away or assign you ETH or BTC. So you have to do a bunch of trades yourself in order to emulate that. But if people get involved and get deep enough into it and you really wanted to execute it, the point is it's there. We're still early in, the derivatives market in crypto, but I think over the next couple of years, 5-10 years, everything that we can do on stocks will eventually be done in crypto.
Makes sense. So, Ray, go ahead.
Okay, are these the vaults you're talking about, the earn vaults on Derive?
I think those are probably similar. I haven't specifically looked at theirs. The vaults for them are actually pretty new. If you click trade up at the top, that's where so you've got ETH perps, but if you click that drop down, nope, sorry, up at the top left. Yep. And then you click ETH options. Yep, there you go. So this will look pretty similar to Robinhood, except it's got all the puts and calls all on one screen. But you can see here, the other thing that they've got here is the bid ask. So Robinhood turns that into a single price for you. But in reality, there's someone bidding and there's someone asking at all times for a given option. Robinhood just takes that middle point for you and says, here's the price. But yeah, like, again, you can see that digital assets, crypto world, it's getting there, right? Literally 2 years ago, a year ago, none of this was here. If you wanted to trade options on crypto, people had no idea what you're talking about. So it's great to see the progress in the space.
Love to see it. Last question here. TradFi options. What do you think is the most interesting stock to trade options on right now?
Yeah, so I think I kind of knew you were gonna ask me this. So I did a quick scan earlier. So some of the largest, highest volatility stocks that are out there right now. So RH, which I think used to be called Restoration Hardware, but it's just called RH now. They're at 220 stock, and their volatility is around 100%. And for reference, MicroStrategy, its volatility is at 106, so just slightly below MicroStrategy.
Wow.
And then there was another one that I saw. So we mentioned Carvana earlier. Same, it's $170 stock. It's got pretty good liquidity, and it's got 83% volatility. Tesla, same 228 stock, 81% volatility. And then Coinbase, $180 stock, 78% volatility. Those are all the ones. Oh, and then of course Hood, $39 stock, 84%. All of those have pretty high volatility, which then turns into high options premiums.
Well, thank you for that list. That's sick. I own Coinbase and MicroStrategy. I did not know about RH. Tesla's another good one, right?
Yep, Tesla. Let me see if I can give you one or two. mRNA, which is Moderna. It's way back down to 34, but it's also above 75. Wayfair, Dollar Tree, Kohl's. A lot of very interesting. Although Kohl's is an $8 stock, so your premiums. It's only $800 to own 100 shares, but your premiums and options are going to be pretty small. But
makes sense. All right. Well, look, Jay, thanks for coming, man. First time Jay's on the show. Ray, I hope you learned a lot about options from Jay. Make sure you give Jay a follow. Jay, what is your Twitter or whatever?
Yeah, I'm just new NFT guy. I've been around for quite a while. When I lived I was back in the States for a couple of years during COVID. So I used to go to NFT NYC and all of those events, but it's been a few years now. But yeah, just new NFT guy. If anyone else wants to just chat options, I obviously love it. Can do it all day, every day. And hopefully we'll see you guys again soon, sometime.
Sounds great. Well, thanks for watching, everybody. That's your options chat for the day. I'll catch you guys next time. Shout out to Jay, new NFT guy. Yeah, they got the banner on screen now. Let's go. Follow him on Twitter. Give him a follow for real.